Hello everyone, welcome to the channel. My name is Fuller Kamara. Today we're in chapter 36, reports to answer common questions. Sometimes with so many reports to choose from, clients may find it hard to select which report can help them drill into the data they need. The client might have the following questions. For example, who owes me money? The report to answer this question is the AR aging summary or detail. So let's see how to generate the AR aging report. The account receivable aging summary or detail lists all customers who currently owes the client balances and how old the balances are. This helps the client to prioritize which customers to contact in order for them to collect outstanding payments from the customers. You can see we have the age of each account receivable, so we've gone through this one, so I don't want us to waste too much time on this, but yeah, this is the one that answers the questions who owe me money. So this shows the customers that owes the business and how long it has taken. You can see some of these has been outstanding for more than 91 days. So the next question is, who are my top customers? So to answer this question, we normally run the sales by customer summary or detail. So the sales by customer summary or detail list out the client customers and how much income they generated in the defined period. So let's say if we go, let's say today, the period is today, and we run the report, you can see, so we have the option to filter this to see the top customers, because right now it is sporadic, but if we want to summarize this or we want to sort this, we can just click the sort drop down, then we click sort from descending order, that is from the largest to the smallest. So you can see right now we have the color cars is the top customer, followed by Freeman Sporting Goods, and we also have the Paulsen Medical Supplies. So this is the third one. So you can see from here, we know exactly our top 10 list. We have what is called concentration risk. That is, if most of our sales is highly concentrated to a specific customer, then there is a risk that if that customer goes out of business, or if we lost the contract from that customer, we might also go out of business. So that's the reason why sometimes it's good to do like a concentration analysis. So how we do that is by dividing the total amount that we generate from that customer, which is the sales by customer, divided by the total sales. So we can see the percentage. So normally, if it is more than 10%, we need to disclose that to whoever our stakeholders are, whether be it investors. We need to tell them that we have XYZ customer. We need to disclose that concentration risk. So then the other question also, what are my top selling or worst selling products and services? So to know the worst and top selling product, we have to look at the sales by product or service summary or detail. So this will tell us the top selling and the worst selling product. So here you can see we have the various products. So if we filter this or we sort this in ascending orders, we can see that we can also collapse this, so we can see the sales. So you can see the top product is the design. The design is currently 56% of sales. That is 56% of the sales is actually the design. Whereas the landscaping is also 42%, 42.87%. Then the worst is the pest control. So you see the pest control currently is 1.07%. So this is a great insight. So it will tell us exactly which products we really need to invest our advertising on and which product we need to discontinue, because from here you can see that our design product is making a lot of sales for us, followed by the landscaping. So if we want to discontinue a product, even though some of these products might not be making large amount of sales, but maybe it might be contributing to our sales, because some of these products might not make much sales, but they might be promoting these other sales. Some products or department might not be making profit, but they might be contributing to the profitability of other departments. So you will sometimes find out only when you do contribution analysis instead of like just looking at the sales itself, because sometimes if you discontinue some of those products, you will end up losing the main product. Like the sales from your bigger picture might decline because of the product or department that you discontinued. So sometimes you have to do that analysis as well. This is just to explain that the design is making the highest sales, followed by the landscaping. So the other area also, we want to see how much do I owe my vendors. So we want to know how much we owe to our vendors. How much did we owe? Okay, so in that case, the report that we need to run is the account payable aging summary or detail. So we have the summary and the details. So we've gone through that. So now you can see this is the report. So this shows the outstanding amount for each vendor. So we can see if we sort this in descending order, we can see that currently, Diego's Road Warrior Body Shop has the highest. This vendor has the highest outstanding balance. You see, so if we are prioritizing, we can see which one we should prioritize first based on the age and also the terms. So currently, even though the vendor looks like it has 755 on the 61 to 90 days, whereas most of the other vendors we have above the 91 and above. So meaning if we have like good terms with this vendor, we can pay the ones over 91 days first, so we don't run the risk of losing our credit. So then we also need to know how much money did I make. So how much money did I make is the profit and loss. We've gone through that on our chapter 35. Okay, so we're not going to run that. We're not going to go into the detail, but that's the profit and loss. It's there to tell us how much money did I make, how much profit. Can I afford to spend money? This is the balance sheet. We've gone through the balance sheet on our chapter 35. It shows how much the business has in cash and assets and how much money it owes. If you look at the top side of the balance sheet, the assets, and then the bottom side is the equity and liability. So it's more or less, we look at the accounting equation, which says assets minus liability equals to equity. You see, so that's it. And we can also look at, on the asset side, we have the cash. So if we have cash and other fixed assets, we know we're in good shape to run the business, because if the business is not making money, and if you look at some ratios, some debts might have what is called debt covenant. So they might put restrictions on our liquidity ratios. They might say your quick ratio should not go below 3 or maybe 2. Then they might say your current ratio should not go below 3. Then they might say your gearing ratio should not go below X amount, So we need to comply. So that's the reason why when we look at the balance sheet, it will tell us if we have enough cash to fund our business operation. We also want to look at how much we owe other people compared to what we have, So we have like the debt to equity ratios that we normally calculate as well. So then we have working capital ratios also. But this is not it. This is just to help you understand when we say how much are we able to fund. Are we able to afford to spend? Are we able to spend more money? So that's the question. This is not the main thing. It's just to help you understand if we're able to spend more money. Then the other question is, how much is my inventory worth? So we want to see the worth of our inventory. So we run the inventory valuation summary, or detail. So we have the summary or detail. So the inventory valuation basically is showing us the quantity on hand, the quantity quantity that we have on hand and the cost. Okay, this asset value is just the cost, how much it cost us. Then you have the average. Okay, so this average is just this cost divided by the quantity gives you this average. That is the price for one. So that's the main purpose of this report, is to show us the quantity and the asset value and the average. That is the cost per unit. So that's it. So if we want to sort this, we can also sort that. So you see currently, so we are looking at the ones with the largest is the design. The design currently we have 500, which makes sense because it's the product that is giving us the highest sales. So that's the reason why we have large value for that and the largest quantity for that as well. So if we go the next one, how much revenue is available to cover operating costs? This is also answered by the profit and loss, because if we have the sales minus the cost, it will give us the operating profit, right? So if we have the sales and less cost of goods sold, it gives us the gross profit. Then if we less our operating expenses, we arrive at our operating profit or our net profit before tax, right? That is if it's a corporation. But if it is like a private like the LLCs, those are pass-through entities. So in that case, we don't pay tax on those because the taxes for those entities pass through to the members, that is the owners. So that's the difference. So in this case, once we are able to generate revenue, then we know that our revenue is able to cover our operating costs, meaning we are profitable. We also have scenarios wherein our revenue may cover the cost, but we're not profitable. In that case, we are break-even. So meaning we make no profit or loss. So that's the point. If we make sales and do not make any profit, it means it's just cover our cost. That means we are break-even. The profit and loss also will show us how much money we earn and spend on each category. We've looked through the profit and loss. If you haven't seen our tutorial on chapter 35, please watch 35. Then the next one, which vendor may also be classified as 1099 contractor? So we want to know, because at the end of the day, according to the tax rules, at the end of the day, we have to file 1099s for any vendor or contractor that we pay more than $600. So we need to file 1099 for those vendors. So we want to know at the end of the day the vendor and if they have been classified as 1099 contractors, because most of the time it is critical to verify and validate which vendors will or should be issued 1099s at the end of each calendar year, because you have to send it before the end of January. So let's look at the vendor contact list. So to run the contact list, we go to the report and search for vendor contact list. So we go to report and search for vendor contact list. So now you can see this is the vendor contact list, but you can see we don't see the 1099 column. You see? So there is no 1099 column. So why? Because it has been hidden. So we click columns to show, you see, any column that has this I with a strike through, it means this is not visible right now. So if we want to show the 1099 for us to be able to track vendors with the 1099, we can just click this and click this also to show whether if the 1099 has been printed. So whatever column we want to show, we can just click to remove the strike through. So yeah, so now if we look for the 1099 column, we can see this is it. So now we know this vendor. What vendor is that? So that vendor currently has 1099. So we need to file 1099 for this vendor by the name of Bros Hannon Insurance Agency. So we need to file 1099 for this. So now let's look. Have we printed the 1099 yet for this? So no status right now. We don't know. But yeah, that's how to check which vendor we need to send 1099 for. Then if I show a profit, why isn't there be any cash in the bank? Because normally not all the time we have profit and still have cash. Most of the time, if we have profit doesn't mean cash. We have what is called called accounting estimate. So accounting profit is not always the same as cash flow, because the accounting profit is subject to accounting estimates, because the management have to use their professional judgment to come up with the accounting estimate based on industry best practices and also the financial reporting framework or gap. So we want to know, sometimes that's the reason why you can see profit but there is no cash. Then sometimes you might also see profit but there is no cash, is due to a lot of your sales are on credit. If you make your sales on credit, you are selling to customers on credit and the customers are not paying, which means your sales on the financial statements, if you are using the accrual method of accounting, because you have the accrual or the cash basis. So if we use the accrual, meaning we can recognize revenue after the earning process has been satisfied. That is, after we've satisfied the performance obligation, we have the right to recognize revenue. Let's say the customer buy a product online. If the customer buy a product from us, we have shipped the custom to the customer, and also we have FOB shipping point and FOB destination. If free on board shipping point, that is after we've shipped, meaning we have earned the revenue. Then in that case, we can send the invoice. We can demand for payment immediately. So meaning we can recognize revenue, sales for that. But if on the other hand, free on board destination, meaning until the goods are delivered to the customer before the risk and reward of ownership is transferred to the customer. In that case, we cannot recognize revenue until the customer receives the goods. So in situation wherein we have that scenario, then you might see, if we have the FOB shipping point, we might see that we have a lot of sales, but the customer hasn't paid because they haven't received the goods. Or maybe if they have received the goods, maybe the terms of the sales, they can still hold on to the cash until certain point before the amount is due. That is, if they don't have the incentive for them to pay on time. Okay, so those are the scenarios. You might see a lot of sales, but there is no cash. It's because most of our cash is being tied up in customer balance. In that case, that's why when we prepare our cash flow, if the receivable is increasing, it means we are losing money. That's why it's a cash outflow. We have to adjust it from our profit, our net profit, when we are trying to arrive at our adjusted cash from operating activities. We need to adjust for non-cash items like depreciation or amortization, then also gain on disposal of non-current assets. We need to adjust for all this stuff. So because if for other reason we have increase in inventory, it means we have spent more on inventory, meaning cash is out. We have paid for us to buy inventory. That's why the inventory has increased from the prior year to the current year. Because if the prior year we have 10,000 worth of inventory and suddenly this year we have 20,000, because we buy more, that's why the value has increased. So in that case, if we're preparing our cash flow, we have to take that into consideration, the adjustment. So let's run the cash flow. So those are the reason why you sell, but you are not seeing cash. Your sales is increasing, but no cash is coming in. So because cash is with the customers. They owe the money. They haven't paid you yet. That's the reason why your cash is small, even though you are making sales. So this is the cash flow. So you can see the cash flow is divided into three main parts. We have the cash flow from operating activities, which is taking into consideration all those operating activities, and the investing activities. So if we look at the financing, so we have three: operating, investing, and financing activities. Then we have the cash and cash equivalent at the end of the period. In a perfect world, this amount should tie back to our cash, our ending cash in our balance sheet. That is if everything goes well. That is if everything has been prepared. But this is a sample company. I don't expect this to balance because we have a lot of adjustments or entries in the bank that has not been reflected. So this number might not be accurate. So the operating cash, you can see it starts with the net income. Then we have all the adjustments to reconcile the net income. So in that reconciliation, you can see AR, inventory, account payable, credit card, all the payables and all these short-term, loans, all will affect the operating because these are short-term debts. So they go to arrive at this reconcile or adjusted cash flow from operating. So this is the net adjustment of 253. So if the cash is increasing, we put it as a positive. If it's reducing, we put it as a negative. Then there are also instances when we have like depreciation, amortization. They also go to this adjustment because depreciation is a non-cash expense, but accounting allows us to recognize that as an expense. But when we look at the cash flow, we just focus on cash, something that is cash to us. So that's why we adjust depreciation. We add it back to the net income. It doesn't affect cash. Why should we put it in there? So we add it back. Amortization, we add it. Gain on disposal, we add it. Gain on disposal, we deduct because we have the gain on disposal actually go to the investing activity. We have the sales proceeds that we recognize on the investing activity. So because we recognize the sales proceed already includes the gain on disposal. So if we recognize the gain on disposal in our operating and then we go back and recognize the sales proceed in our investing, meaning we have double counted our gain. You know what I'm saying? So it has double counted the gain because to arrive at the gain is sales minus the carrying value. So that gives us the gain. We are also going to recognize our sales proceed in our investing activity. That's the reason why we have to remove it from our accounting because accounting already recognized the gain. You see, the accounting profit only recognized the gain on disposal, but did not recognize like the total proceeds, like to say, okay, the sales proceeds, only the gain. That is cost minus the carrying value gives you the gain. That's what goes in the accounting profit, whereas the sales proceeds has not been included. So that's why the cash flow only corrects the gain which was recognized in the accounting by deducting it. If it was a loss, we add it back. If it's a gain, we deduct it. What gives us a loss on disposal? If the carrying value of the asset is greater than the proceeds, we have a loss on disposal. So in that case, we add it back to our profit because when we have a loss on disposal, when we recognize it in the accounting profit, in the income statement, we deduct it from our income. So you see, but it's not actually, we don't have to deduct it. That's the reason why in the cash flow, we add it back. So now to arrive at our net cash provided by operating. Provided, if it is positive, it is provided. If it is negative, used, because we use those cash for operating. But in this case, it's positive cash flow, which is a good thing. Then the cash flow from investing. So you see, cash flow from investing, you have the truck, the cost of truck. That if we buy a long-term asset, a fixed asset, so the cost goes there. Then if we sell also a fixed asset, the proceeds on that sale goes in here. So that's why we have the cash flow from investing. Cash outflow right now. The cost is an outflow because we pay to buy the asset. But if it was proceeds, meaning we receive cash for that. Let's say we sell our old motor vehicle for 5,000. That's a proceed to us. So meaning we receive that proceeds. How did we recognize the proceeds? We debit cash, right? So we debit cash for the proceeds that we receive. Then we account for the cost of the asset. We remove it. Okay. So we remove the cost of the asset. The difference is either gain or loss. So that's how to account for the disposal. That's the end of chapter 36. Please don't forget to subscribe, like if you like the video. See you in the next video. Thank you.